Thanks, Sophus. Thanks, Nicola. I'm going to talk about this work together with Lydia Marsden, who's the lead author colleague from UCL, also Jesse Abrahams and Tim Lenton, who are from the Global Systems Institute at the University of Exeter. So it's a nice economists and non-economists, like real scientists team, which is always good. Tim Lenton, as you may know, has been a sort of leading authority on this concept of environmental tipping points for a number of years, and that's his most recent report on this topic, which was launched at last year's COP28 in December. What is a tipping point? Essentially, it can be understood as a small change, a small perturbation, to use the technical language, that can actually lead to a very large shift, a regime shift in the state of an ecosystem or an environment that can result in a permanent loss of the resilience of that ecosystem. So this is a diagram that's often used to try and capture what's going on. But the really important point about these tipping points really is their non-linear nature. This is not a system that one can understand using many of the kind of more dominant models, particularly in economics, which are equilibrium-based models involving marginal change, essentially. And this is one of the reasons I think we wanted to look at this in more depth, because we felt like the standard tool set, I guess, or theoretical frameworks for understanding risk, particularly in the financial regulation space and the macroeconomic modeling space, we didn't feel were well equipped to deal with these kinds of dynamics. We actually published a report in April called Ecosystem Tipping Points, Understanding Risks, the Economy and Financial System, which made the case really for why macroeconomic policymakers, financial supervisors, central banks should be interested in these dynamics and going through the types of risk. I'm going to do a very quick version of that today, but the focus today is going to be on an exploration of two particular ecosystems, the Brazilian Amazon and the Indonesian tropical peatlands, which are critically important, and the financial flows that are associated with the activities, man-made activities, that are damaging those ecosystems. But before we get to that, I just wanted to give you a slightly broader introduction to the work that I'm doing at UCL together with a couple of colleagues. It is about trying to develop a slightly different approach to the financial policy, I guess you could call it in the broadest sense. So we're interested in monetary policy, financial regulation, financial supervision, to some extent fiscal policy as well, but the focus has mainly been on financial supervision. The current consensus, I guess, or dominant framework for dealing with both climate-related financial risks and nature-related financial risks, we tried to sort of summarize here. It's really seen as a kind of market fixing problem, an information problem. There is insufficient information in financial markets about the nature of climate or nature risks. And the challenge of the policymaker is to fill in the gaps, to get market actors to understand those risks and provide that information. And the market will then price better those risks. There will be more efficient price discovery. Then that will result in a change in capital allocation, lending, investment by financial firms, and we will hopefully have a kind of smooth transition. Challenges to improve transparency with better reporting, a sort of task force on climate-related disclosures, now nature-related disclosures. We've also had, and Nicola's been involved in some of this work around scenario analysis and stress testing, all pointing towards this sort of outcome. Now, there are some big assumptions here, which I've been challenging in my work. One is, are we really talking here about risks? And risk, if you look at the actual definition of risk, is essentially something where you don't know the outcome, but you can assign a meaningful probability to a range of different outcomes. And that enables you to essentially put a price on that risk and then essentially hedge your investments and your portfolios accordingly. The challenge really is, are we, particularly with phenomena like ecological tipping points, where there's a huge amount of uncertainty on the timing, on the severity of the risks, multiple different causes driving the risk, are we really talking about something that can be meaningfully estimated, or are we in a world of fundamental or radical uncertainty? And then the second assumption is that firms, when they have this information, will act upon it. That again is something that's being challenged in the sort of academic literature, certainly at the moment. Just to give you one example, it is now the case that the unit cost of green electricity is cheaper in many cases than fossil fuel unit costs of electricity, but we haven't seen a big shift in investment, partially because the returns on fossil fuel, where the infrastructure is already there, are still subject to less uncertainty and are surer and are higher. Brett Christophers has written a great book about this challenge called The Price is Wrong quite recently. Those are two assumptions we've sort of been challenging in our work. The other, it's not really an assumption, but it's just a kind of way of thinking about the problem, I suppose, is the majority of focus within the financial supervisory space has been on what's called single materiality. So the worry is, how does the environment and the economic system create financial risks for financial firms? Can we calculate those risks, measure those risks, and create this price change, as opposed to the impact of the financial system on the firms that are causing the damage and directly on the environment, on the ecosystems, which is more of a, just generally termed, double materiality. So there's been an interesting sort of ongoing debate about whether or not financial supervisors should care about double materiality, because central banks, for example, typically are mainly focused on financial stability as opposed to environmental stability. But we're sort of arguing that you should care about this double materiality and the endogenous impact of finance on the environment. So that brings us to this alternative framework, I guess, which we've been calling precautionary financial policy. Essentially, the argument would be, rather than trying to predict the impact of these environmental damages on individual financial institutions, i.e. the single materiality risk exposure model, we could think about trying to instead prevent the worst case scenarios, which are exactly these environmental or ecosystem tipping points, which we know will lead to massive catastrophic impacts, macro-financial impacts. If the Brazilian rainforest degrades into a state of savanna or desert, we know that that will have terrible impacts, not just regionally, where Latin America is hugely dependent on hydropower for a huge amount of energy, huge number of jobs, huge number of commodities exported from the Amazon, but globally, because the Amazon is a vitally important carbon sink to absorb CO2 emissions, and hitting 1.5 degrees by 2050 will become extraordinarily difficult. The idea really is to focus on the activities and the financing of the activities contributing to these tipping points and how to avoid them. I mean, obviously you can focus on other major environmental problems other than just tipping points. But the idea is that you kind of know that probably nearly all banks will be to some extent negatively affected by one of these tipping points happening. So you can sort of basically say, even though we can't calculate the risk to individual institutions, we know macroeconomically, from a macro-prudential perspective, this is an intervention that can be justified. You're really focusing on building system resilience, staying in this more resilient space than falling into this change space where the system itself becomes much more vulnerable to these various types of shocks. What is driving these ecosystem tipping points? Well, a lot of the focus has been down here on climate change, which creates less rain, more heat, which we know all about, CO2 emissions. But we wanted to also think about the other main driver, which is land use change, which is the deforestation, which people know a bit more about, but there's other forms of land use change, drying out areas, particularly in the peatlands. You dry out the peatlands in order to then grow palm oil, typically is a big problem in Indonesia, or generate pulpwood. And of course, these two activities interact and speed up the process by which these ecosystems begin to degrade and move towards tipping points. Our focus has been very much on the land use change activities, because obviously climate change is driven at a global level and you can't geographically kind of specify where the finance is going. You can obviously look at finance going to the big energy companies, big oil firms. But we were interested specifically in, can you connect financial flows to specific geographically mapped ecosystems on the ground? So the two ecosystems we looked at were the tropical peatlands in Indonesia and the Amazon rainforest. And this just goes through the importance of those two biomes, both hugely important sequesters of carbon and vital for regulating rainfall in these two regions, regulating the hydro cycle, and both globally important stores of biodiversity, as well as being the home of millions of people and sources of food and support for local livelihoods. Translating that into financial and price stability risks, which is what central banks and financial supervisors care about, you can have these three main categories. Idiosyncratic risk, which is the risks to the region, the regional ecosystem services, direct macroeconomic impacts at that level. But then there's also these systemic risks, which I've talked about around carbon sequestration and compounding effects. One of the challenges with ecosystem tipping points is if one of them happens, it increases the likelihood that other tipping points around the world will also occur. And an important aspect of this is the limited substitution possibilities for large-scale nature degradation. This is another challenge for many macroeconomic models, which assume relatively high rates of substitutability. So we lose one kind of natural resource, but we're able to substitute via changes in technology so that the impact on GDP is relatively small. And that's been an interesting debate at the moment around many of these models failing to properly factor in the levels of GDP damage from nature loss on a large scale. And then the endogenous risk, which I've talked about a little bit. There is also a kind of political economy angle here, which is financial actors pushing for higher yields, potentially seeing land as a speculative asset as opposed to simply an area to grow commodities in the more standard sense. And that is an area that I think is ripe for more exploration, but it's not something we go into in this paper. It's something I've written about in a previous paper, if you're interested in that. So as I said, the focus is on these two research questions, really. What is the nature of the financial flows supporting companies most implicated in land use change in these two ecosystems? And we also looked at the extent to which finance is a strategic lever for change, i.e. the extent to which the companies involved in the damaging activity are really sensitive to external finance, or less, or not. Previous research in this area has looked at global industrial sectors, but not spatially mapped those sectors. So you have tools like the Encore framework, which has looked at these global sectors in different and come up with exposures for financial systems of different countries at the national level. Or they've been country focused and company specific approach, and again a focus on the exposures of financial institutions, so the transition risks faced by banks or financial firms. There has been some spatially mapped land use change studies on specific ecosystems, but rather than looking at financial flows, i.e. loans made by banks, syndicated loans by investment banks, or the issuance of corporate debt or equities, these studies, where there's used spatial mapping, have only looked at equity holdings. So they've been rather studies of corporate financial power, you might say, in the sense of which shareholders are holding the shares and could potentially influence what those companies are doing. So it's a slightly different focus. Our focus is on financial flows that enable the ongoing activity of the firms or enable them to expand and do new things in the sector, because we really did find a research gap there. In terms of the data and methodology, we use the Trace supply chains data set, which is aggregated to the corporate group level. And we included all groups with a minimum of 1% exposure to land use change in the two ecosystems, averaged over the most recent years of data. Our study is to some extent biased towards larger firms in that sense. We then used the London Stock Exchange and Bureau van Dijk Orbis data sets to map the corporate groups identified in this trace database to legal entities accounting for M&A activity, and got these various figures and excluded corporate groups with no identifiable legal identities. And we then looked at the financial flows over the last 10 years to these firms and investments in these firms and mapped those to their ultimate parents. We looked at 4 sectors: the beef sector, the soy sector in Brazil, and we looked at palm oil and pulp in Indonesia. And those are the sectors which are most associated with land use change. We ended up with 39 firms, which covered, I think, around 90% of all the traceable land use change in those sectors. And they were a mixture of public, private, and part listed firms, mainly multinationals, diversified companies, particularly for soy in Brazilian Amazon and for wood pulp and palm oil in Indonesia. The meat sector is a bit different. In Brazil, this was more domestic Brazilian firms, and fully private companies accounted for between 36 and 52% of our data. So I can show you the breakdown. The top one shows you the firms exposed to land clearance for soy in Brazil. And you can see it's pretty concentrated. And then for beef is the second chart. And then for Indonesia, the picture looks like that. Senile mass, particularly dominant in the wood pulp sector. And in terms of the financial flows, you can see here by type of financial flow, overwhelmingly bank loans were the most important source of finance for these firms, but bond issuance becoming more important in recent years, interestingly. So post-COVID, it seems like bond issuance has become more important, possibly because of the low interest rates that we had for a while, that we've now no longer got. But you can see that this is not just a story of bank loans. Corporate debt issuance is important. And then in terms of the geography, where are these financial flows actually coming from? This is the Amazon. We've just plotted here the different financial flows from different countries, with the larger bubbles showing over 100,000 million US dollars and going down 10,000, 1,000. And you can see there, I guess this is the big story of the research really, most of the financial flows going to these firms involved in land clearance in the Amazon are coming from the global north, in particular US, Europe, and China, much less from South America. Brazil is an important player, but much less important in scale than the global north. And then before we get to Indonesia, let's look at the breakdown of that more specifically. And you can see US there is by far the biggest single country contributing finance to those firms. But Europe is, when you add up all the European countries involved, you can see they're actually bigger than the US. And these are the major firms that you saw in the previous slides. And you can see many of these firms taking finance from multiple different parts of the world. These are big, global, diversified, multinational firms. But they are associated with significant amounts of land use change in this ecosystem. And then the Indonesia story is very different, much more regionally concentrated. So China is a big player here. Indonesia itself is actually the biggest provider of finance to firms operating in land use clearance in Indonesia. Europe still plays an important role, particularly the UK, it seems. But yeah, much more of a focus in kind of Asia, East Asia, supporting that activity. And you can see there the breakdown by region for those different firms, the vast majority coming from Asia. And this is the companies themselves for the two ecosystems. And you can see for the Brazilian Amazon, the US major investment banks, Citigroup, Bank of America, JP Morgan are top. Barclays comes in fourth, and the Chinese state-owned investment corporation is fifth. And then quite a few large investment banks from Europe involved there, and a very different picture in Indonesia, where most of those firms are from. Asia, this is a highly concentrated picture again. There's essentially 10 or so banks doing most of the financing here, which obviously is interesting for financial regulators who might be interested in trying to reduce these financial flows. One challenge for regulators is that as a proportion of their total portfolio, these ETP risk forms of financing are very small for these banks and other financial institutions. You can see there for the Brazilian Amazon, mostly they're under 1% of their overall financial flows. So if you were to say to them, we're going to stop you, we're going to force you to hold so much capital that you stop making these loans to these companies, they might not be that bothered in terms of the bottom line of their balance sheet. In Indonesia, it's a slightly more mixed picture. Some of these financial groups do have more exposure to those types of firms. And then we also looked at the financial sensitivity of these firms by looking at two other ratios, these companies' debt to asset ratios, which is a pretty standard metric for financial leverage and financial sensitivity. So how much debt have they got compared to their total assets? And we also looked at their retained earnings to assets ratio. And there you can see some quite big differences. The beef sector in Brazil, the green line down here, you can see their debt to asset ratio is quite high. So they might run into more difficulty if you started to restrict those financial flows or increase the interest rates or make their cost of capital higher. But for the palm oil sector, possibly less of an issue. And again, some sort of heterogeneity as well with those sectors in Indonesia. Again, a mixed picture really in terms of financial sensitivity to external finance for these firms. If you have large amount of retained earnings and your lending suddenly becomes more expensive, or it's just shut down because of financial regulation, you can obviously, in theory, carry on financing that with your retained earnings. So you're less sensitive to the type of financial regulation that we're interested in. To conclude, key findings: damaging activities in these critical ecosystems are concentrated amongst a relatively small number of agri-commodity firms involved in the export of these key commodities. There is major transparency issues because these firms are highly diversified multinationals with complex subsidiaries, structures, and internal financing mechanisms. We came across one firm that was basically financing its subsidiaries with its own money with a sort of complicated internal financial mechanism. Around 10% of all financial flows to that company were coming from its own financial subsidiary. And this, limits causality claims, but those financial flows also highly concentrated. One other interesting finding was that the financial flows were, in some cases, quite different from the demand flows or the trade flows. So for the Amazon, the demand for the commodities, beef and soy, primarily is domestic from Brazilian firms, Brazilian households, and Chinese, but the financial flows, as we saw, mainly from the global north. For Indonesia, the relationship between the financial flows and the commodity trade flows is a bit closer, with Japan and the UK as kind of exceptions, in the sense they're providing a lot of finance, but they're not actually importing that many of these commodities. Policy implications: I guess the results throw up this interesting idea that, how do we deal with this kind of lack of transparency around what these firms do with the funds they receive? One option is just to force them to disclose what they do in more depth, what their internal financing subsidiary structure looks like. Another option is just to say any loan to these firms that are engaged in this damaging activity should be regulated, or you're forced to hold more capital if you're lending to that firm. Personally, I'd sort of lean towards that latter direction perhaps, but counter argument would be, well, these firms maybe are trying to transition towards different models. Maybe they have transition plans. That's obviously the direction of travel in the climate space at the moment. Another implication, I think, is that microprudential policies aimed at looking at the transition risk facing banks that are financing these companies. It's going to be hard to justify forcing banks to hold more capital based on transition risk, because the transition risk is so low given all the other stuff they're financing, these huge banks. So this interventions can only be justified on a macroprudential base, with the argument that these firms are contributing to the buildup of systemic risk towards ecosystem tipping points. The other main conclusion, I think, would be it's probably not enough just to say the central banks and the financial supervisors can lead this transition on their own. It's pretty clear that given the complexity of these firms and the fact that they're globalized multinationals, it's going to require policy coordination. It's going to require environmental regulation. It's going to require perhaps innovations in tax policy. Many of these firms offshore a lot of their profits to avoid tax. That might be an area to look at. And we also need industrial policy to encourage the countries in question, Brazil and Indonesia, to again transition to export models which are less damaging, ecologically damaging, but still enable these countries to earn the dollars they actually need to develop. Thank you.